Imagine a world where a, a piece of software is basically the only thing standing between you and completely out of control grocery prices.
Which, I mean, it really sounds like science fiction.
It totally does. But according to a newly updated, heavily researched global investment playbook from April 2026, betting on artificial intelligence is actually the ultimate inflation strategy.
And for you listening right now, that is probably a wildly counterintuitive idea.
Oh, completely. Because if you look around at the current economic reality, it feels like we are all living in this bizarre financial paradox. Inflation is incredibly stubborn, right? You're seeing the US CPI hovering stubbornly around like 3.3%.
Yeah, it just won't budge.
Exactly.
Mm.
And the threat of stagflation, that nasty wealth-destroying combination of stagnant economic growth and persistently high inflation, is just looming over the market like a dark cloud. And the old rule book, the one that told you to build a nice, safe 60-40 stock and bond portfolio to weather the storm.
It's practically on fire. It is just failing.
Right, it's just totally breaking down.
It is entirely failing. And that is incredibly frustrating for anyone trying to protect their purchasing power. When you have structural inflation eating away at the value of your currency every single day, playing it entirely safe with cash or pure bonds, well, mathematically, it just guarantees that you're slowly, quietly losing money.
So how do you navigate this? I mean, how do you protect the purchasing power of what you already have while still figuring out a way to actually grow your wealth over the next decade?
Well, that is the mission for today's deep dive. We have gotten our hands on this really comprehensive global investment strategy report, and it isn't just theoretical economics.
No.
It's a highly practical, actionable playbook designed for exactly the precarious economic reality we are standing in today. What's fascinating here is that the report forces us to completely rethink traditional asset allocation. It outlines a very specific, dynamic, four-part global strategy. But more importantly, it doesn't just tell you what to buy. It gives us the exact red flags we need to look out for in the tech sector's quarterly earnings to avoid the next major market correction.
Okay, let's unpack this, because before we can even start talking about exactly what percentage of gold you should own or which tech stocks to watch, we really need a core philosophy. We need to understand the architecture of this approach.
Right, the foundation.
Exactly. The report introduces this central framework, and they call it the left-hand, right-hand strategy.
It's a brilliant way to conceptualize the problem of stagflation. Think of the left hand as your active defense against present-day inflation.
Okay.
This hand holds assets that historically protect your purchasing power when the basic necessities of life get extremely expensive. We are talking about commodities, energy, physical gold, and TIPS, which are, Treasury inflation-protected securities.
Oh, right.
This specific strategy is drawing heavily on the harsh lessons we learned during the 1970s stagflation era.
So the left hand is essentially the shield. When fiat currency loses its bite, these hard, tangible assets hold their underlying value because, well, you can't just print more oil or gold.
Precisely. But here's the problem. A shield doesn't win the war.
Yeah, it only keeps you from dying.
Exactly. That brings us to the right hand, which is entirely focused on betting aggressively on growth. And in the context of this 2026 report, the right hand is the Nasdaq, and specifically the Magnificent Seven tech giants.
Okay.
The market right now is heavily allocating capital to these companies, not based on today's inflation data, but pricing in future AI super profits.
I see the theory. It's almost like being a boxer, right? You absolutely need your left hand kept high to block the hits from inflation.
Right.
But your right hand has to be throwing massive punches if you want to actually win the match and build long-term wealth. But I have to push back on this right-hand strategy.
Go for it.
Why tech? Historically, when inflation is high and interest rates go up, investors usually run away from high-growth tech stocks.
That's the traditional view, yeah. But if we connect this to the bigger picture, it fundamentally changes how we view technology. The report argues that tech-driven productivity, specifically the rollout of AGI, or artificial general intelligence, and the deployment of smart machines, is theoretically the only viable path the global economy has left to truly squeeze costs out of the system.
I'm trying to visualize that. How exactly does a piece of software or like a large language model squeeze physical costs in the real world?
Well, think about the core structural drivers of the inflation we are seeing today. You have the rising cost of human labor, the skyrocketing cost of services, and these massive frictions in global production.
Right.
If AGI can augment or replace a massive amount of cognitive and administrative human labor, and if AI can optimize physical supply chains and logistics to a degree human managers simply cannot, it acts as a massive deflationary force.
I see.
It essentially produces significantly more economic output for dramatically less input. So by investing in the Nasdaq, you aren't just buying software companies for their revenue.
You are investing in the very underlying technology that will eventually cure the inflation disease.
Exactly.
Okay, wait, hold on. If the goal of the left hand is to buy things that are scarce and the right hand is building the AI to solve inflation, aren't those two things in direct conflict right now?
How do you mean?
Well, doesn't building all this AI infrastructure, like the massive data centers, the cooling systems, doesn't that require unbelievable amounts of power, copper, silicon, raw materials?
Oh, absolutely.
So if the data centers use all the electricity, doesn't that just make everything else more expensive for you and me?
That is a highly astute observation, and it is exactly why you need both hands.
Yeah.
The report deeply addresses this tension.
Okay.
In the short term, yes, these data centers fighting for grid power and advanced chips are absolutely pushing up inflation. We are seeing immense strain on resource markets.
The commodities.
But the economic projection here is built on an overlapping timeline. The short-term pain of building the infrastructure drives up commodities, which is precisely why your left hand holds energy and gold.
Oh, wow. So it actually profits from the build-out.
Exactly. That is a necessary bridge we have to cross to get to the long-term deflationary payoff of AI productivity. The left hand profits while the right hand builds.
That dynamic is fascinating. It covers your bases perfectly. But if we are talking about tangible assets for the left hand, my mind immediately goes to real estate. I mean, they aren't making any more dirt, right?
Sure.
Does the report view land the same way it views gold? Because usually people say real estate is the ultimate inflation hedge. Yet, looking at this, the report caps land and real estate at a maximum of, what, 20 to 30% of the portfolio?
It does, yeah, because the underlying reality of holding real estate in 2026 has fundamentally changed compared to previous decades. The friction costs are rising incredibly fast, and they're starting to outpace the yield.
Friction costs, you mean like the hidden structural fees of just owning the property?
Exactly. We aren't just talking about a leaky roof. We are looking at post-pandemic property tax hikes across municipalities. Skyrocketing insurance premiums because structural climate risks are rendering coastal and fire-prone real estate nearly uninsurable. And just ever-tightening regulatory costs,
Wow.
especially in Europe and North America. These friction costs are just eating the yields alive. Yes, farmland or prime residential real estate will always hold its underlying value, but it is becoming incredibly difficult for the net after-tax growth of real estate to outpace the sheer velocity of AI-driven tech growth.
So it is a vital stabilizer, but it is no longer the ultimate growth engine.
Exactly.
So if real estate is just the stabilizer, and the right hand is the true growth engine heavily invested in the Nasdaq and the Magnificent Seven, I guarantee that you, the listener, are probably feeling a bit terrified right now.
Yeah, for sure.
You are worried about buying at the absolute top. We've all seen the headlines. The anxiety is palpable. Are we in a massive AI bubble right now?
It is the single most important question an investor can ask today. To answer it rationally, we really have to contrast the current AI investment frenzy against historical bubble cycles.
Okay, let's do it.
Let's look at the actual data. Right now, the Nasdaq 100 is hovering around the 25,800 to 26,000 mark.
Which definitely feels high.
It is high. The forward price-to-earnings ratio, the forward PE is about 22.39, and the trailing PE is around 36.45.
Let me jump in really quickly for the listener who doesn't, stare at valuation metrics all day. A forward PE of 22 essentially means that investors are willing to pay about $22 today for every $1 of expected earnings these companies will generate next year. It's basically a gauge of how optimistic the market is. So 22 is optimistic.
Highly optimistic, yes. Are those numbers elevated compared to historical boring market norms? Absolutely. But, and this is a crucial distinction, this is absolutely not the 2000 dot-com bubble.
Right. People always make that comparison. Every time tech goes up, they scream 1999.
They do, but the underlying mathematics completely reject that comparison. During the dot-com bubble, forward PE ratios soared well past 40x, sometimes into the 60s and 70s, for companies that had zero actual revenue and no viable business model. Today, we are looking at a forward PE in the low 20s for companies that are generating the most massive, verifiable cash flows in human history.
Here's where it gets really interesting, because the valuation isn't just built on hope or eyeball clicks. It's driven by massive, real-world capital expenditure, CapEx. The report calls it out specifically. In 2026, the seven giants are projected to spend between $650 and $700 billion entirely on AI infrastructure.
That number is staggering. It represents a 60 to 70% jump in spending just from 2025.
Let me break that down for you listening, because $700 billion just sounds like monopoly money until you hear who is actually writing the checks.
Yeah, it's wide.
Amazon alone is projected to spend about $200 billion. Alphabet, Google's parent company, is at $175 to $185 billion. Microsoft is putting down $144 billion, and Meta is dropping $115 to $135 billion.
It's an arms race.
It really is. But wait, I have to challenge this premise. Usually when a company burns billions in cash, investors freak out because it eats into profits. How does burning $700 billion actually hold up a valuation? Why is this different?
Because the market doesn't view this as burning cash. It views it as pouring the concrete foundation for the next decade of the global economy. This CapEx is buying physical land, advanced cooling systems, and massive silicon clusters.
Okay.
It acts as a revenue floor. As long as these titans are in a nuclear arms race to build the best AGI, that $700 billion flows through the economy, propping up the semiconductor companies, the energy grid, and the construction sector.
But there is a catch, right? Because money isn't free anymore.
Exactly. And this is where global interest rate trends become the critical variable. The current Fed funds rate is sitting at 3.5 to 3.75%.
Okay, so if these tech companies are so rich and making so much money, why do interest rates matter so much to their stock price?
Because of how Wall Street values future growth. When interest rates are at zero, a dollar of profit earned 10 years from now by an AI company is worth almost $1 today.
Right.
But at 3.75%, you can get a guaranteed risk-free return just by buying government bonds. So a dollar earned in the future is mathematically worth significantly less today. If tech growth stumbles even slightly, investors will quickly rotate out of tech and into those safer high-yield bonds.
Oh, causing the stock's valuation multiple to violently compress.
Exactly.
Okay, I want to clarify something here, though. Does high interest rates mean we are going to see a repeat of 2008 where the banking system just collapses?
No, and the report makes this clear. Modern monetary policy has evolved. Concepts drawn from modern monetary theory, which essentially suggests governments can and should print money to sustain their economies as long as it doesn't trigger runaway inflation, combined with the Fed's proven ability to execute rapid quantitative easing, meaning central banks buying securities to flood the market with cash, makes a 2008-style liquidity freeze highly unlikely.
Okay, so the central banks will step in.
Right. However, a valuation reset bear market, where stock prices plummet to match the new interest rate reality, is still very possible.
Which brings us to the absolute most practical part of this deep dive. If the market is currently propped up by $700 billion in corporate spending, what happens if the music stops?
The report identifies a very specific high-risk window. We are looking at the second half of 2026 going into 2027. This is the danger zone where the infrastructure is largely built and the market demands to see the profits.
So we need a practical, actionable checklist. If I am a listener sitting at my computer reading the quarterly earnings reports for the seven giants over the next year, what exactly am I looking for? Give us the early warning valuation triggers that signal it is time to rotate out of these AI-heavy assets.
Well, there are three glaring red flags you must watch for in these earnings reports. Red flag number one is CapEx guidance. You need to look at the forward-looking statements from Microsoft, Amazon, Google, and Meta.
Okay, and what's the trigger?
If any two of those major players downgrade their 2027 CapEx guidance, or if their CapEx growth drops from that 50+% level down to roughly 10%, that is your immediate signal to act.
Because it means they are done building. It's almost like building a massive nationwide high-speed rail network, right?
Precisely. As long as they keep aggressively laying the track, investors are thrilled, employment is up, the steel companies are thriving.
The land developers are making money.
Exactly.
But the second they announce they are going to stop buying steel, or worse, if they finish laying the track and no passengers actually buy tickets to ride the train, the entire speculative valuation of the project collapses.
That's a perfect analogy. And that leads directly to red flag number two, which is essentially watching the company making the steel in your analogy.
NVIDIA.
Yes. You must watch NVIDIA's GPU shipment growth. If that shipment growth drops below 20%, or if the major cloud providers signal in their earnings calls that they quote-unquote have enough compute for their current models, the market will aggressively and violently reprice the entire sector downward.
Wow. Okay, so we're watching the track being laid with CAPEX and the steel arriving from NVIDIA, but eventually, like we said, people need to ride the train. Are we looking at whether these companies are actually making money off this AI?
Yes, absolutely. Red flag 3 is entirely about the revenue side. Is the passengers buying tickets part? You need to scrutinize the ratio of AI revenue versus AI spend.
Okay.
If these companies are spending $200 billion, but their AI enterprise software or consumer subscription revenue growth fails to cover that massive capex, it will begin destroying their free cash flow.
And free cash flow is the actual cash a company generates after accounting for cash outflows to support operations and maintain its capital assets.
Right. Investors will tolerate massive spending for a while, but only if the revenue curve is aggressively chasing it. If that gap widens, the market will punish them severely.
Okay, so our radar is calibrated. We know the exact red flags to look for in the earnings reports. But now we have to talk about how you actually construct this portfolio and, honestly, how you manage your own human emotions when the inevitable corrections happen, because they will happen.
Oh, they always do?
Let's look at the actual blueprint. The report gives a sample global allocation designed specifically for this precarious high inflation environment.
Yes, it breaks down to 4 distinct asset categories, and the magic is really in how they interact. First, 40% is allocated to the Nasdaq or the 7 giants. This is your growth engine.
Got it. 40% tech.
Second, 30% goes into commodities, energy, and physical gold. This is your inflation hedge.
Yeah.
Third, 20% is held in cash, short-term bonds, or defensive stocks like healthcare or utilities. This is your buffer. And finally, 10% is allocated to land or REITs as an optional hard asset stabilizer.
So 40-30, 20-10, I see the balance, but wait, 30% in commodities and gold? That feels incredibly heavy for a modern portfolio. How does this actually work dynamically when the market crashes?
Think of it as a seesaw with a shock absorber. If the tech sector drops 20% because of an AI revenue miss, your 40% growth engine takes a hit.
Right.
But usually that means inflation is still running hot or energy is constrained, meaning your 30% commodity bucket is likely rising, stabilizing the total value.
Oh, I see.
Meanwhile, your 20% cash and bond buffer sits there, perfectly insulated, generating a 4% yield, giving you the dry powder to buy the tech dip when things get cheap.
That makes incredible sense mathematically. But let's bring up the human element here, because a spreadsheet doesn't feel panic, but you and I do.
We certainly do.
How should a retail investor emotionally handle a major sector correction? The report points out that historically, the Nasdaq sees brutal drops of 30% to 78% after these massive bull runs.
And this raises an important question. What kind of investor are you? Because the psychology of investing is often way more important than the mathematics. The report compares 2 different strategies for long-term wealth building, contrasting long-term buy and hold against rule-based rebalancing. Let's call them Strategy A and Strategy B.
Okay, lay them out.
Strategy A is the classic buy and hold, never sell, buy the dip approach.
The diamond hand.
Exactly.
Yeah.
Mathematically speaking, over a 20-year horizon, this strategy usually wins the spreadsheet battle. You capture all the long-term upside of human innovation, and you completely avoid the devastating mistake of selling at the absolute bottom.
But in reality...
But psychologically, it is brutal and almost impossible for most people. It requires a level of emotional detachment most human beings simply do not possess.
Yeah.
When your 40% allocation to your tech growth engine drops by 40% in a single month, the panic is overwhelming. Most retail investors will capitulate. They will sell at the exact bottom just to make the emotional pain stop, locking in permanent losses.
I will happily admit I've been there. You look at your screen, everything is red, and you just want the bleeding to stop so you can sleep at night. So if strategy A is too painful, what is strategy B?
Strategy B is what the report actually recommends for anyone seeking to balance long-term wealth with portfolio stability. It's rule-based rebalancing.
Okay.
It is a hybrid approach. The key is to establish your rules before the panic sets in. You write them down when you are perfectly calm.
So I'm not making decisions on a Tuesday when the market is down 1,000 points. Give me an example of a specific rule.
For instance, you could set a firm rule based on those valuation triggers we discussed. If the Nasdaq 100 forward PE exceeds 28, or if two of the CapEx red flags appear in the upcoming quarterly earnings, I will automatically reduce my tech exposure by 30 to 50%.
Wow,
You
okay.
do this mechanically. You don't think about it. You just lock in the profits.
And what if the market tanks? How does the rule work on the way down?
You have a rule for the downside, too. If the market drops 25% from its peak, I will automatically take money from my 20% cash buffer and add it back into the growth engine.
That's brilliant.
By making it a strict pre-written rule, you completely remove the emotion. You aren't guessing the future, you're executing a tailored plan.
So what does this all mean for you, listening right now? It means that currently, as we sit here in April 2026, the data says there is absolutely no need to panic sell. The AI CapEx train is still accelerating. The core recommendation is to hold your positions, maintain your four-part allocation, particularly through the U.S. midterm elections in November, as markets historically generally strengthen in the back half of election years.
Right.
But, and this is the absolute most critical takeaway, you must rigorously watch the Q2 and Q3 earnings reports using that specific three-part checklist we just went through.
Exactly. The current macroeconomic environment is precarious,
Yeah.
but it is entirely navigable if you balance the left hand and the right hand, and if you let cold, hard data, rather than emotion, drive your portfolio rebalancing.
Well, I want to thank you for acting as such an incredible guide through this incredibly dense financial playbook. Understanding how to dynamically balance the left hand defending against inflation with the right hand aggressively capturing technological growth is going to be the absolute key to surviving and thriving in the 2026 economic landscape.
It has been a true pleasure. But before we go, this raises one final lingering question, one that I want to leave the listener to ponder based on a subtle risk warning in the source material.
Oh, I love these. Let's hear it.
We discussed how we are betting on AI to create massive productivity and eventually kill inflation. But the report warns that the rollout of true artificial general intelligence might take much longer than expected.
Right.
In the meantime, these massive data centers are aggressively hoarding electricity, copper, and silicon.
Right. The short-term pain of the infrastructure build.
Ask yourself, could the very AI technology we are relying on to cure long-term inflation actually be the primary catalyst driving up commodity and energy prices over the next 2 years? If so, your left-hand inflation hedge might just end up being as profitable as your right-hand growth engine.
Man, what a thought to end on. The cure causing the symptom before it finally heals the disease. For everyone listening, keep your eyes heavily focused on those quarterly earnings reports, stick to your pre-written rules, and don't let the daily headlines panic you. We will catch you on the next deep dive.